Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at moving averages. When I say moving averages, that can refer to a simple moving average or an exponential moving average. We'll cover both of those. They're the most common types that you'll find being used by investors and traders. And moving averages are used in a lot of the other calculations used in other indicators such as the MACD and Bollinger Bands. The first thing you need to know about moving averages is that they smooth out price. They eliminate noise. Here you can see price activity goes up this far, pulls back this low, and starts to move up here this far, right? Same time period, you can see that the moving averages, both the simple and the exponential, are much more calm or less volatile than that. So that's one of the benefits of moving averages, that they remove a lot of the noise out of the market. Moving averages can also act as support and resistance zones. They shouldn't be treated like exact points, but definitely zones, areas where you're going to start to find support and resistance. There's a couple in particular that almost everybody tracks, and that's the 50-day moving average and the 200-day moving average. Those are so followed by everybody else that they almost become like a self-fulfilling prophecy. Whenever you see price pull back down to the 200-day moving average, so many people are watching it that you actually expect to find support there, and you typically do. So is that because people are expecting it to happen, or because it was going to happen anyway? Who knows? But that's something they also will often do. Okay. Moving averages can also help you determine the trend. Whenever your moving average is pointing up, it's telling you the trend is up. When it's pointing down, it'll tell you the trend is down. This is just something you should come to notice over time. If you're new to trading or any type of technical analysis, just looking at moving averages can help a great deal. Moving averages can also be used to generate buy and sell signals. In some cases, some traders will use that. What they'll do is we'll get to that in a minute, but that they're using different time periods on their moving averages. They're not using, like in this particular case, I'm showing two separate moving averages. One is the estimated moving average, and the other is the simple moving average, and they're both set at 10 periods. That wouldn't be what they'd use for the signals. They would use one maybe a 50-day, another one a 10-day, or something like that. We'll get into that in a moment. First, let's discuss how a simple moving average works. Right off the bat, let me tell you that there's no one's not better than the other. They both have positives and they both have negatives. So let's examine that. All right, the simple moving average on this chart is the blue line. Simple moving average is what it sounds like. In this particular case, it's 10 periods. We're marked right here. That 10 indicates that. So what they've done is they've taken the close of the past 10 periods, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. They've taken the closing price of this time period, added it all together, and divided it by 10. And that gives you this blue line right here. 122.98 is that number that you would come up to if you actually added all that up. Those are lagging indicators. They're both lagging indicators, but you'll notice that it's lagging more than the exponential moving average, which is this red line. The reason for that is that the exponential moving average takes the same calculation. However, in the case of a 10-period estimated moving average, or EMA, they're applying an 18.18% weighting to the most recent price. This price right here has got more weight on it than the other past data. So it's responding quicker to new information, while the simple moving average does not have that benefit. So simple moving average is going to lag more than the estimated moving average. However, whenever you're dealing with simple moving averages and estimated moving averages, you're going to find that the simple moving average, because it's a true average, it's going to act as support and resistance better than the estimated moving average, and especially on the longer time frames. So that's something else to think about and weigh. Which one you use will be dependent on what style of trading you're using, and how important it is to you to decrease that lag. In the situations you're looking at short-term moving averages like we are here, where they look at 10-day or 10-period moving averages, that's really short, and they're going to track price pretty well. But if we expand out to a 50-day moving average, I'll show you that in a second, you'll see that there's a great deal more lag to it. And if we go out to a 200-day moving average, there's even more, because there's just that much more past data that's in the calculation still. So it's just kind of being weighed down by all that past data. Okay, here we are looking at two simple moving averages. This is the 50-day moving average and the 10-day moving average. You should be able to tell which is which just by noticing how closely the moving average tracks price. In this situation here, you can see that the moving average tracks price relatively well compared to this blue line here, which is obviously the longer time frame here. The 50-day moving average is this blue line, and the red, or this black line here, is the 10-day moving average. You can see that the longer the time period there, obviously the more lag you're going to have with the particular average. What you can do though, and a lot of traders will use this method, and they have varying ways of doing it. They may use a 200-day moving average, a 100-day moving average, etc., etc., or even shorter. Rather than a 10-day, they may use a 5-day as well. And they may use estimated moving averages as well. Right now I'm showing you two simple moving averages. What they will do is they will use them as a signal line, basically, whenever the shorter term moving average crosses below the longer term, like you have here. You've got the longer term here, and then you've got this shorter term moving average crosses below that. They'll consider that a sell signal, and that's what that red arrow is indicating. And that's a sell signal, so they will exit the market here. And then they will wait for the situation to reverse, and when the shorter term crosses above the longer term moving averages, like you see there, they would consider that a buy signal, and they'd be buyer there. And they would continue to buy or hold until a low point gets taken out. So they'd advance and then pull back, and advance and then pull back, and at this point they'd actually be taken out, and they would exit there. At the same time, they were getting a sell signal here as this shorter term moving average crossed below the longer term. However, in using this strategy, you will often get what's called whiplash, where you get a sell signal and then you turn right around and you get a buy signal. As you'll notice, the short-term moving average crossed below the longer term and then crossed back up the other way, so you'll be getting a buy signal again. So you can see whiplash in this method that people use. And then you can see again here is exit signal, and now we're getting a buy signal again. This is a 5-year chart of the Dow Jones Industrial Average, in case you're wondering. The concepts here that you need to know is that you'll hear people talk about a bearish crossover of the moving averages. This would be this guy. A bullish crossover would be this. The death cross would be this. The golden cross would be this. So if you hear those terminologies being tossed out, you know what they're talking about. And typically they're referring to the 50-day and the 200-day moving averages. They're so widely tracked by everybody. So when those two cross, people talk about it. Another thing that you're going to see people do is talk about a close above a moving average or a close below a moving average. Some traders will simply use the logic that when a moving average is acting as support, it's bullish, you should be a buyer, and whenever it's acting as resistance, it's bearish, and you should be a seller. Here you can see that the moving average is acting as a support zone here. You had price activity moving up here, and pulls back down, touches it, jumps up here, dips below it a little bit, goes back up here, dips below it again. But every time she's closing above that moving average, she remains in an uptrend, the trend is pointing up, the whole thing is proper. And then at some point you get a close below. That's a negative signal, and they would consider that a sell signal. So they would exit and just wait for something to change. And if they start to see resistance forming, where price activity would sell off below the moving average and then advance up to it and then ricochet off of it, that's acting as resistance. Here you go like this, back over here towards it, and ricochet away from it. You'll see that it starts acting as resistance. They'll be using those moves back to that moving average as sell opportunities or short opportunities. So they would short the whatever asset class they're looking at those points, as long as you remained in the downtrend. And they would consider it a downtrend until you had a situation that reversed, where you had a close of a period higher than the moving average itself, and that happened here. So at that point they become buyers. They would continue to do that. However, you are also going to get whipsaw or whiplash in this situation. You're going to get situations where you're going to get false signals. And so here you had a close below the moving average, and then turn right around and you get a buy signal, then a sell signal, and then a buy signal. So these are things that you should take into account. No method out there is 100% flawless. Everything has to be taken with other indicators. I wouldn't use a simple moving average or an estimated moving average or of any time frame as my sole indicator for when to get in and when to get out, but some people do. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.